Happy Wednesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Wednesday, September 11th, 2024. Before we get started, I just wanted to give a huge heartfelt shout out and thank you to all our first responders out there and our active and non-active members of the military. You guys do a wonderful service for our country. We just want to say we really appreciate you, obviously here on our Remembrance Day for 9/11 from here in the city. So I'll start with our executive summary here from today's leadoff morning note. Today's key macro question is, have we seen the top in bonds? Our answers are, that feels like an unusual question to ask with asset markets currently engaged in a growth scare correction just ahead of the commencement of a Fed rate cutting cycle. But if history is any guide, it is the right question to ask, because historically, when the Fed begins cutting the policy rate in a late cycle economy, bonds typically peak within the first few months after the initial cut. Within a late cycle expansion. Why? Because the easing prolongs the expansion and the inflationary pressure associated with growing the economy amid full employment. For what it's worth, that outcome remains the highest probability outcome according to our analysis of persistent leading indicators of the business cycle. The August CPI report was telling in this regard. Perhaps the effect of forward guidance may have pulled forward a considerable degree of the rally in bonds as well, which KISS, our systematic KISS portfolio structure process, and our Dr. Mo discretionary risk management overlay have helped 42 macro clients remain on the right side of since early June. What little we heard about forward-looking policy from either candidate last night's U.S. presidential election debate confirmed that another round of populist fiscal policy is likely in 2025. Transitioning to our 42 macro dashboard here. As always, a wrap up with the question from our community. This one's regarding global liquidity versus Bitcoin. It says, hi, hey, Darius and team. I've heard on more than one occasion that as soon as global liquidity starts to rise vis-a-vis China's stimulus and U.S. easing, Bitcoin will begin to benefit. My question is, what is the actual vehicle that transfers that global impulse into Bitcoin directly? Does it first flow from central bank to retail investors and then to Bitcoin? If so, then what is that liquidity? Then why is that liquidity rises almost instantly reflected in increases in Bitcoin? So obviously a little poorly written, but that's all good. So so let me unpack this as well. So I'll start by saying that, with respect to liquidity and how it impacts asset markets, the reason the rising liquidity impacts asset markets, or falling liquidity impacts asset markets, because of what liquidity actually is. Liquidity is a unit of capital that you can either spend into the economy from the consumption standpoint, or that you can invest. And the reason that rising liquidity tends to cause asset markets to appreciate is because people don't want to sit in cash, generally speaking. The returns on cash are, for most times, and most throughout financial market history, are lower than the returns on most assets. And therefore, investors, when they get more cash into their accounts, they tend to either consume it or they invest it. And when they invest it, the returns on those investments, those assets, are generally speaking, well in excess of cash. And so you think about how liquidity actually winds up in our accounts as human beings and as financial institutions. It comes from several ways. So private sector creates liquidity. So I think it's important for investors to realize that it's not just central banks. Most retail investors are myopically focused on central banks. Us institutional investors understand the flow of liquidity across all the various, agents in the economy. So starting with the private sector, generates liquidity through two ways: corporate profits, and then when households save money, and they retain their wages. And so that becomes a pool of capital that grows over time as the economy expands over time. That ultimately winds up, back in asset markets, or in terms of financing investment in the economy, or financing or not in asset markets in terms of financing consumption in the economy. It depends on the investor preferences, things like valuation, things like the outlook for the economy. Those will be what's driving those decisions. When liquidity comes from central banks, it can come from two forms as well. So when the central banks can expand their balance sheets, i.e., acquire assets in order to, push liquidity into the broader financial sector, or as reserve managers, when the companies within those economies, generate earnings abroad. Those earnings get repatriated, and then they sit on the balance sheets of central banks. And central banks tend to sort of recycle those funds into sovereign debt bond markets, reserve currency sovereign debt bond markets, which the U.S. is about 60% of that total flow. And then finally, liquidity comes from the repo market. And so the activity in the repo market, the repo is you can create liquidity out of thin air as long as you have collateral. in the repo market. So, the level of interest rates, the direction of travel of interest rates, and ultimately invest the volatility in the bond market and the currency market, because there's a lot of cross currency transactions. The volatility in the bond market, the volatility in the currency market, and the direction of travel of interest rates will all have a significant influence on the activity in the repo market. So there's three specific places that liquidity comes from, and we have to track all three, and we do track all three in the context of our 42 macro global liquidity proxy, which is the aggregated sum of central bank balance sheets, broad money supply globally, and FX reserves minus gold, with the bond market volatility overlay to simulate the influence of the repo market. And so that metric has helped 42 macro clients remain on the correct side of the liquidity cycles for the past couple of years. And ultimately, I think we do a great job quantitatively forecasting liquidity, and we have our models have quantitatively forecasted, generally speaking, that liquidity is going to decrease over the medium term since the spring. And if you go and pull up a chart of Bitcoin or Ethereum since the spring, our model's been very accurate in actually calling for the decline that we're seeing with respect to those types of assets. So investors need to be aware that there's you've got to understand that this stuff is a lot more complicated than it sounds like on Twitter, than it sounds like on podcasts. That stuff will get you in the right direction. But again, you don't want to be playing with toy models with your entire net worth. And so we definitely want to recommend that if you do care about liquidity, which you very much should as an investor, to come check us out at 42 Macro. So we'll wrap it up there. Darius Dell presenting our Macro Minute for Wednesday, September 11, 2024. Thanks for tuning in. Best of luck out there, and we'll catch you back here tomorrow. Cheers.